Hello and welcome to Smart Investing Market Insights. I'm your host, Krista Das. Week after week, the talk of the town, the common thread underlying almost any stock position you can take right now, has to be energy costs, specifically the prices of oil and gasoline. The price of crude oil at the Cushing, Oklahoma terminal crested $60 per barrel in late February. This is actually a bit late compared to 2006, when prices held above that mark for the vast majority of the year, and reached as high as $75.63 by the peak of the summer driving season. However, in 2005, we did not see prices hit the $60 mark until July, and in 2004, oil never rose higher than $54 a barrel. Now, I'm no oil expert, but I do know rising prices when I see them. And I also know just how much it hurts to fill up at the gas pump, where gasoline is already less than one thin dime away from $3 per gallon. But that's just me. To tell us how oil and gas will impact the market this year is market analyst for Wave Strength Options Weekly, Adam Lass. Adam, you specialize in exactly how the market perceives and acts on stimuli like this. Can you tell us, first of all, how high you see the prices of oil and gas going this year?
Yes, Krista. It really does hurt to gas up right now, and that pain isn't going away anytime soon. It's all about relative inelasticity.
Relative inelasticity?
Yes. One of the most fundamental laws in classic economics is demand and supply elasticity. I mean, simply put, when folks want something, smart entrepreneurs go out and find it for them. And if folks want it a whole lot, the price goes up. On the flip side, when prices get too high, folks tend to decide that they don't want something all that badly. This causes prices to drop and supply to fall off, and eventually the whole shooting match stabilizes at levels comfortable for all. However, these natural adjustments cannot happen to oil prices right now.
Why not? As prices climb, why don't end users simply use less gas, just as the economic model states?
Because the American consumer is locked in. The past 20 years at least, we've been investing in larger and larger houses further and further from work. Now we're locked into these houses. We certainly can't sell them in the current market without incurring losses, and we can no longer refinance with impunity so as to squeeze more available cash out of them. So instead, we have to light them and heat them and cool them and commute to and from them. So we can't reduce demand anytime soon. But entrepreneurs can't increase supply either. OPEC is already pumping every drop they can, and American refineries are turning it all into usable fuel about as fast as they can without blowing a gasket. So the price has nowhere to go but up.
So how high up is this impact going to affect Wall Street?
Up for oil means the mid to high 70s by mid-July per barrel, with crisis-driven spikes as high as $80 per barrel not out of the picture.
And gasoline?
I've been predicting $3 a gallon for gas by mid-spring for some time now, and since we're at that point now, for all practical purposes, this once radical idea is now old news. What has me frightened is the very real possibility of $4 a gallon by midsummer.
So, Adam, how will that affect the stock market?
Well, it's hard to say how it will impact the big blue chip lists as a whole. After all, companies like ExxonMobil, ConocoPhillips, and Chevron are prominently weighted on many of these lists.
Thanks, Adam. We appreciate your being on Market Insights. If you'd like more information on the companies Adam just talked about, you can find out more at taipanfinancialnews.com. That's it for this week's show. Have a great week. I'm Krista Das, and I'll see you right here at taipanfinancialnews.com.